Thanks for tuning into this broadcast. I'm your host, Neeraj Shah. Guest today is Vinay Jaising of JM Financial. Vinay, great having you. Thanks so much for taking the time out. Have to start off, while amidst all the news that exists, have to start off with the new kids on the block, or I can't even call them kids because some of these are large IPOs, but just the action and the nature of the action that we're seeing in the primary markets, Vinay. Is it something to take note of? Because the subscription levels and the subsequent listings and the quantum of paper is very, very high.
Absolutely. You know, when last time you asked me this question about how much money our mutual funds are sitting with, that number a month ago was about 1.25 lakh crores to 1.5 lakh crores. It's now at 1.9 lakh crores, or about 6% of the overall AUM. So it's proving to you, if there's a good quality paper, good management, great business strength, you will start seeing the IPO listing well. And I think that's what's happened. The brand, is fantastic to say the least. And, just on the housing space for a minute, it's very interesting. If we got one thing positive in this budget, which the government came out in for F 2024-25, it was the housing space. Please remember PMAY or housing, affordable housing has been pushed by the government. That is the single most important core area for them. So Bajaj Housing may not be fitting into it, but the housing area is growing between 12 to 15% per annum.
Yeah. So when I actually just a follow-up to that, you reckon that NBFCs, okay, let me rephrase my question. NBFCs in the last 6 to 12 odd months have more often than not gotten the bitter end of the stick. Capital market players, even like your business or otherwise, there have been a lot of activity around that, and at the receiving end a lot of times. It's after a while that we're seeing this flavor coming back within housing finance companies and within other NBFCs as well. Is it here to stay?
So my bet is one thing which is going pro the NBFC space is the interest rate, which will come down for India. Also the inclusion of India in the MSCI EM, be it in Reuters or Bloomberg, will get the NBFCs who want to borrow money from the rest of the world. They would also have a lower cost of capital compared to the past. So if your cost of capital is in control, if the equity markets are doing well, the IPO markets are doing well, I think business is here to stay.
Okay, business is here to stay. You seem to be constructive on that bucket. Would that, just before I talk about rate cuts, would that bucket, or maybe it becomes a part of this, but would that bucket or that thought extend to banks as well? Bank Nifty has been relatively sedate, still away from all-time highs, while Nifty and Sensex are doing what they're doing. Can banks make their presence felt, or are there other sectors or better opportunities to invest within other sectors, Vinay?
So I would believe on the latter. I think banks have one big question which is coming up. The growth which will come up will be corporate capex growth. Corporates do not pay as much as retail India. So you would see probably the interest on the loan fee growth or the yields which the corporates give being much lower. So if the yields are coming down, the interest rates are coming down, they are at such efficient operating levels. You may not see the bottom line growth even be equal to the loan book growth. So yes, the stocks are cheap, but we think there are better bets in other sectors around.
Okay, and I'm gonna come to those sectors in a bit, but let me first get them. Okay, or maybe Vinay, we do the macro at the end, right? Because it's a big Fed week. Since we're on the topic of sectors and themes, let's just finish that, and then I'll come to the macro. Two or three very important macro questions starting today itself. But first, so if there are other sectors to bet on, where do these pockets exist at the current valuations, at the current juncture of the market? And if you're investing there, if investors are investing there, should they brace themselves for possibilities of downside as well because of the markets looking so heady?
So on your question, it's very important now. Investors should realize we are close to the peak of the market. The market this year itself, depending on the index you make, is up 20%. And that's after a stupendous year last year. So if I had a seesaw battle, valuations for the indices are clearly high. But what's weighing down is the liquidity, which is so strong that the valuations can be higher for longer. So in this kind of a situation, I think you need to start adding some defensive bets. And I think pharmaceutical and specialty chemical, despite pharmaceutical being one of the best performing markets sectors in the last 3 months, I think is a favorite for us. Out here also, if you were to focus on those contract manufacturers, the CDMO plays, which play with as the domestic formulation market grows, these players get orders, be it from the Sun Pharmaceutical or the other players, the other big domestic players of the country, you start seeing their growth being very strong. So we would bet on pharmaceutical and specialty chemicals, and more importantly, those names, which are under 25 times P with a growth of 20 to 25% in a higher row. So that's, I think, one space we would look at. The other space we would look at is in the power sector. Power sector has some good large caps and cable companies and even equipment EPC companies. This is one space which has been grossly underinvested by the government. By the government implying PSU's capex as a percentage. If I had to take power as a percentage of government budget plus PSU capex, let's say 10 years ago it was 14. Today it's 4 to 5%, and the overall power capacity, which is a little shy of 450 megawatts. That number is more than expected to double in the next 5-6 years. So there's a lot of investments happening in capex. Transmission systems have to be built, cables are required. So you have a plethora of I would say stocks which you can play with in the power sector. So these are the two spaces we are most excited on.
Okay, Vinay, what are the risks to the market? Now, the reason I ask this is we've been listening to cautious commentary around why the markets may have peaked since maybe what 2,500 points back. I mean, at 20 to 500 around the elections, people said that this is it, and no matter what the outcome might be, there will be a tactical bounce, but then the markets have to correct. From there, we've gone up 3,000 points on the Nifty. It's been a remarkable ride. Now, my question is, what could bring the markets lower, except for valuations? Because we are on the cusp of a rate easing cycle, and historical trends notwithstanding, rate easing primarily should be considered positive for risk assets.
So, I agree with you on this comment as well. Currently, apart from valuations, so you may say even that too for the indices. So one may look at bottom-up ideas. So this is an ideal time to look at stocks as compared to markets. Our perspective, everything's pretty positive for India. If I just look at the domestic inflows, if I just look at the ownership of DIIs and not including retail, that number at about 16.8% is more than what FIIs own today at 16.3%. If I look at the FII ownership today compared to the last 13 years, it's at 13 plus year low. So it's a matter of time. FIIs will also have to put in money into the country. And if I look at the UUHNI/retail investments in the country, that is surging. So today, if I had to look at just from April 1st to now, the inflows which domestic India, all domestic India put together, including DII as well as insurance companies, that number is north of $24 billion. It's already in less than 6 months, probably the third highest inflow the country has ever seen. I also mentioned the cash in hand position today at 1.9 lakh crores, or about 6% of the AUM itself, is equivalent to about 7 to 8 months of plus SIP data, which you get on a monthly basis. So today the domestic is firing on the liquidity front. Once the FIIs fire, because the GDP of the country is much better, the economy of the country is much better, courtesy crude prices and our tie-up with Russia, we may land up with a current account surplus. So things are a lot more positive today on the Indian currency as well as on the Indian economy. You may start seeing people look at India a lot more robustly. MSCI has already increased its weightage, from 6%, around a decade ago to about 18-19% today. As against that time frame, the FIIs, as we were saying, were underweight. So I think the technical parameters are suggesting the market could rise up. There could be corrections, but you'll see a lot of buying coming in those periods of time. Apart from geopolitical risk and some valuation calls, I think the market is looking very solid.
Okay, and that's a fair call too. Okay, big data point or big things that happened over the course of the last 24 to 48 hours. A second assassination attempt or talks of that, at least on Donald Trump. Does that make the US election even more volatile, and does it have an impact on risk assets until the outcome is out of the way or even after that? Let's start with that first, Vinay.
Sure, I think so. The US elections can't be undermined. Volatility would be galore. If you were to look at, what the press is talking about between Trump as well as Harris, this thing has been a yo-yo battle. At one time, Trump's votes were higher as a percentage. Now it seems Kamala Harris's votes, have inched up to 49 as against 47 for Trump. But these numbers can change a lot. Volatility, I think, is going to be here because both of them have different policies. If you look at what Trump wants to do, he wants to cut taxes so that you can have more growth, more profitable growth coming in for the companies in US, and that would lead to whatever the fiscal deficit US has to substitute with. The growth would come in from corporates, and that way. On the other side, Kamala Harris is looking at increasing the tax structure so that 3.3, 3.4 trillion PBT which US has. If you increase the taxes by 10 to 15%, you get $400 to $500 billion coming in from that kitty. Now, both tell you different dynamics. If you increase taxes, you can see short-term pain in the market. If you cut taxes, you can see the market's doing well. Also, their policies on China seem to be radically different. I would say at one end, Trump's talking about increasing the tariffs substantially, 60%, 100%. We're reading these numbers on the press, but much higher than what it is currently. So that at one end would make India look a lot more attractive because you can see Make in India stories go to US, but that at the other end could also question what's going to happen to the inflation impact to US because things coming from China are a lot more cheaper, and that may not allow Trump to reduce taxes as much. On the other side, it's status quo of what had happened historically. Also on the Fed part, whatever we can read, Trump does want to interfere a lot more in cutting interest rates, which may not be possible. But mind you, as interest rates get cut, and if it gets cut in US faster than the rest of the world, you can look at a weaker dollar compared to the rest of the world. So volatility, I think, with the US election is galore. That's a fair comment to make.
Okay. Vinay, we will just one final question, actually, if I can squeeze in very quickly, Vinay. Chinese data just doesn't seem to be gaining any strength. Is it time to put the China bets and therefore bets on all things which benefit out of a China resurgence on the back burner, wait for the data to come out? It's okay to buy it 5% higher, but let it come out because it's becoming completely unpredictable.
No, I think so. China data is becoming tougher and tougher to predict. You're seeing more slowdowns than, growth. Earlier, we were talking about a 5% GDP hike in China on a year-on-year basis. Now that number is going to be, downward revised by most of the economists, maybe 4.2 or 4.5%, which also may be difficult to achieve. So I agree with you on that comment that for now, let China go back on the back burner for whatever you're looking at direct investment. Having said that, I think what we should look at as far as India is concerned is where does India have an upside courtesy the US elections as well as what's happening in China? Where can they make for themselves a moat? And I think that's again where you have specialty chemical and pharmaceutical CDMOs coming up, or probably some defense bets coming up, where India could become a much stronger global house, in terms of exports.
All right, so that was JM Financial's Vinay Jaising talking about why he is bullish on India and his top sectors. Also he spoke about how to play China, which is extremely interesting because there's so much happening over there as well.